so much going on in literally everything right now. It's hard to keep on top of. I sound like a stuck record, but I've been saying this for a while, I think future expected growth is going lower, and that is what the bond market is picking up. The bond market had quite a strong day today, even though if you go to Google Trends and look at inflation, it's all-time record high mentions of inflation. The bond market still is nowhere near where it was back at peak in terms of yield. It rallied, the yields went up, came back down again. So it's fascinating that the bond market seems to suggest something different. The other thing that I've been talking about for a while was the propensity for the dollar to rally. That's played out in kind of big style over the last 3 weeks, where we saw a huge move, well, a relatively huge move in the dollar. And that's, again, I think, picking up on the weaker growth sentiment. It's not a yield sentiment because yields were higher earlier and the dollar wasn't higher then. It's to do with this, the fact that if you raise the price of food, gas, natural gas, and everything else on people, their propensity to spend goes down over time. So even though we're still seeing decent retail sales numbers, my guess is later we will see less. Now you've just added yet more COVID complications. You know, Europe, that doesn't look good right now. And Germany's talking about, do they do some partial lockdown, some full lockdown? I look at the chart of the Spanish stock market, it seems to be breaking lower. So there's something going on out there, but equity markets tend not to crack until the purchasing managers' indexes go, or indices go below 50 or head towards that level. So they're still relatively strong, they're coming off. So there should be no reason yet for the equity markets to really have any sort of shock, because the kind of things I'm talking about, the lower yield play and the higher dollar play and the slowing growth, are all stories for next year and not this year. Again, I've talked about this on the daily briefing with you frequently, and you know, economies move like super tankers really, really slowly. But when they head in a direction, they're hard to stop. And the super tanker is turning. People just can't see it yet. That's my view. And the markets, the markets that are paid to listen, like the bond market, seems to be listening, as does the dollar. The University of Michigan surveys I've mentioned before, they break it down by spending category, like housing, cars, big ticket durable goods items. These are all-time record lows, the propensity to spend. And the reason being is they're overly expensive. That's what the survey comes back with, all-time record. So as always in financial markets, the rate of change that shocks people. And you know, 2-year yields have increased massively, then all of these costs have increased massively. So borrowing costs have risen, costs of buying stuff has risen, and everyone's going, you know what, I need to be careful. And if this sticks for a while longer, yeah, it's a problem.
Yeah, 2-year yields have quintupled from earlier in the year, trading at around 50 bips on a yield basis right now.
And people will laugh at you, say, you can't look at them in terms of percentage gains. It's simply not true, and I pointed this out in 2018 when we got the end of the kind of yield rise. People were like, you can't look at it in those terms. I said, it's the rate of change that matters. Because let's say you are a large corporate or family office or a bank, and you've refinanced money, you know, 1-year money at 25 basis points, and next minute it's trading at 100 basis points. That's a massive difference in your funding costs, because most people have taken on more leverage. So, yeah, I think it's a meaningful risk.
So is the risk off trade here buy the stinking S&P? I mean, what's happening?
Yeah, it always is. Because don't forget, let's play through the scenario. So maybe I'm right. Maybe the economy starts to weaken. Maybe the ISM starts hitting 50. What happens next? The Fed print money and the S&P goes up because they've debased the denominator. So, yeah, we're in a different world here. It sounds ridiculous. Doesn't mean you can't get the sharp sell-off, the quick 20% sell-off over 2 weeks.
Right.
But if it's signifying anything to do with the economy, anything more than that, and the Fed's in again, saying, you know, they're going to calm the markets, and then if they see economic growth slowing down, they're going to stimulate again.
Yeah. By the way,
that's their trick, right?
more hawkish talk from the Fed today, which, maybe means this sort of counter indicator, precisely what you say.
That's right. And if the hawkish talk from the Fed mean that bond yields start falling, I understand the yield curve, though 2 years have been going up, but generally it's telling us that the forward expectations of inflation are going to fall over time. I always say I listen to the bond market and I'm listening intently. Again, this is not a story for now. This is a story that we're seeing slowly, like a snowball at the top of a hill, rolling down, picking up, more gravitas as it goes.